Hey, are you a business owner, entrepreneur, or professional? If so, we want you to apply to be a featured guest on our show. My name is Adam Torres, and I host the Mission Matters series of podcasts. I've recorded over 3,000 episodes, and we are just getting started. How do you know if you'd be a good guest to be on the show? Well, only one way to find out, and that's to apply, but I'm going to let you in on a little secret. We want guests that have a story to tell, guests with a brand, a product, or a service that can benefit my audience of listeners. If this sounds like you, go to missionmatters.com and click on Be Our Guest to apply. I'd love to talk to you and get to know more about your story. Again, head on over to missionmatters.com and click on Be Our Guest to apply. All right, now let's get into the show. Hey, I'd like to welcome you to another episode of Mission Matters Money, your source for all things money. My name is Adam Torres. You can follow me on Instagram at AskAdamTorres to keep up with my book releases, book tour schedule, signings, all that other good stuff. Always love to connect with you there. And as always, if you'd like to apply to become a co-author of one of my upcoming books, just head on over to the website, missionmatters.com, and click on Become an Author to apply. All right, so today I have Ted Parkhill on the line, and he's CEO and founder over at Incline Investment Management. Ted, welcome to the show.
Thanks very much, Adam. Great to be here.
All right, so excited about today's topic. A little bit controversial, but not really. I think it's great. So discipline matters, what many investors lack. So we're going to definitely dive into this. But before we do, I'd like to know a little bit more about what you're doing over at Incline Investment Management. Tell us a little bit more about your company, please.
Sure, thanks. We are a quantitative investment manager. What that means is we use proprietary algorithms to make our decisions as to how we invest, where we invest, and how much. So everything is driven by our quantitative systems. And so at the end of the day, we consider ourselves a systematic macro manager, which means we track and trade as many global markets as we possibly can, ultimately giving investors the exposure to those markets, typically what they won't get from their average investment advisor or broker.
So the obvious on today's topic, so discipline matters, what many investors lack, is pretty straightforward. So what have you found, or why have you found that this discipline is important? And maybe it helps to define discipline a little bit, because that's a broad one.
Yeah, that's a good point. When I think of discipline, I think of athletes and the military and why they're successful. What's the formula for success, and why is it so important in both, in sports and our military? They're great because they have discipline. It works because they follow a program, and that's exactly what we do in the investment space. We follow a program, and it's sometimes really difficult to do that, to have that discipline, because your gut may be telling you one thing, but the only way you can be a quantitative manager is to really follow your system. And there are times when you want to second guess it. The moment you second guess your discipline is the moment you're no longer a quantitative manager. And there's lots of discretionary managers out there, and they're investing with their gut, and some of it works and some of it doesn't. And our view is no one has a better crystal ball than anyone else. I learned that firsthand working for one of the legends in the quantitative space, a guy named John W. Henry. They're known today for his baseball hobby. He's the principal owner of the Boston Red Sox. And John was one of the pioneers in the quantitative space, and I worked for him for a number of years. And I applied some of the lessons I learned working for John to what we're doing today. And discipline is the key. There's no secret to Merrill Lynch's early success. The story goes that Merrill Lynch, used to hire Marines. Why? Because it worked. Marines were the types of guys they wanted. And to us, in fact, my own team, we have a number of my partner is a student athlete. And a number of the young guys I've hired on my team are student athletes or former student athletes. And so we look for somebody who's going to get up, make it happen and stick to the system as best we can and apply that in everything we do. That's the key.
No, that's great. And I think just to go a level deeper here, let's get into maybe some of the nuts and bolts of this. And I know a big thing that you're focused on is the idea of correlation and non-correlated results. What makes that so important or special? Because I know that when we think of correlation, first off, the next obvious connection would be diversification, right? They kind of go hand in hand. So let's talk a little bit more about that and how it fits into your approach.
Yeah, great question, Adam. The thing about correlation is that people don't really understand it. They remember their 10th grade statistics if they're lucky. But correlation is actually really easy to explain. Positive correlation, or plus one, is really defines a relationship. So I like to think of it as a school of fish. A school of fish everyone can visualize. A school of fish swims together. And so that's what positive correlation is. It moves together. There's a relationship. The thing about positive correlation, though, it has positive connotations. That's dangerous because a school of fish can see a shark and dive. And that's what we saw in the financial crisis. The financial crisis, we saw what people thought to be non-correlated or uncorrelated investments like real estate and equities. They had positive correlation and they tanked together in the 08-09 financial crisis. And so when somebody thought they had sufficient diversification, they owned a basket of equities in their second home in Tahoe where we're located, they discovered the hard way that wasn't the greatest protection. Negative correlation, minus one, is also easy to understand. You generally think of bonds and interest rates. If interest rates fall, bond prices will increase. We get that kind of relationship. What a lot of us don't understand or don't even know about is really non-correlated performance. And non-correlation, the reason it's hard to understand is because there's no relationship. So my own mother still calls me and says, "Oh, Ted, the market's up. You must be up." Well, not necessarily, because we have directionally agnostic trading. We can short a market as easily as we can be long the market. So I have to train or remind my mother constantly that's non-correlation means no relationship. The benefit or the net benefit of adding a non-correlated asset to a portfolio is not immediately intuitive. You can look at a standalone risky asset and say, "Ooh, it's too risky." But what a lot of investors don't realize is you can take that riskier asset and add it into your portfolio, and if it is non-correlated, you can actually reduce the overall portfolio risk and increase return. It's classic modern portfolio theory, and it's all about shifting the efficient frontier rather than just moving along the efficient frontier curve. And so from our perspective, non-correlated performance has its own value. The way you try and generate non-correlated performance is the real trick to the equation, and that's what we specialize in doing.
No, that's great. And so, in your opinion, and obviously this is going to vary from investor to investor, portfolio to portfolio. But I know you follow the market, you see a lot of different portfolios. Do you think that investors are in general are diversified typically?
They think they are. It sort of goes back to my point about sufficient diversification. What does that look like? And from our perspective, on almost all countries, we all have a client or sort of a country bias. We all focus on the S&P 500 because we all live in the United States. But and savvy investors will know that we do live in a much more global market than that, and there are many other markets to follow. In one of our trading programs, for example, we trade all of the equity exchanges around the world. So we trade the CAC 40 in France, the DAX equity index in Germany, the FTSE 100, TOPIX, etc. We trade all the global currencies. We trade all of the global fixed income markets, the Boon, the Schatz, the Bobble. Most of these markets, most typical U.S. investors just haven't heard of or don't have access to, and couldn't if they tried, because most of the brokers and advisors don't have any clue that these even exist, much less on how to advise their clients and how to gain access to these markets. And that's where we come in as an investment manager. We track all of these global markets and provide access to these to investors because there's so much opportunity around the world. And the trick to it is identifying where that opportunity exists. And that's why we're a quantitative manager. there's no way we can be expected to know the political situation in Ghana and how that might affect cocoa prices. But I can tell you one thing: if cocoa prices are going up, we're gonna be long. We're gonna own cocoa. If cocoa prices are going down, we're gonna be short. And so the question is, how many investors do you know have cocoa in their portfolio? You know, and what do they know about it other than eating their favorite chocolate, you know, on their break or whatever it is, right? So we trade all these markets, and we trade it with a very disciplined approach, but we provide that diversification. At the end of the day, by trading all these markets, we provide the diversification that generates the non-correlation. That's what our mission is.
Yeah, and looking at looking at how sophisticated the markets have gotten through the years. I mean, once upon a time, we go back to like a John Bogle or something, like he thought, oh, you have the S&P 500. Well, there you go. Now, if you're holding the index, then you have Exposure International, because these companies do business international. Well, the world and the markets have just changed so substantially through the years since some of those original theories that it almost seems like you have to really, really consider these things that you're mentioning if you do want to be truly diversified. It's no more just hold a couple of index funds and then you have a big basket. That basket's moving in the same direction now, long story short, because everybody's holding that same basket. So I love your thought process and diversification and how you're making that possible for many more investors. So that being said, Ted, I know we barely scratched the surface here, but I do know that you also have quite a bit of work out there. How do people follow and connect with you and your team and your writing and everything else so that they can learn more?
Sure. We run a blog that is called Investing with the Trends. It's investingwiththetrends.com, and so we write regularly on it and just sort of what's going on in the markets and so on. Of course, you can always connect with me on our website, which is inclineim.com. And, we are a private investment manager. So, today, obviously, in a call like today, Adam, we're not going to talk about our performance or our limited partnerships or anything like that, because of regulatory reasons, you generally don't do that. But if somebody wanted to track us down, and they could absolutely, and we'd be happy to have a chat with them. The trick is that they have to come to us directly. Typically, if they're with a big brokerage firm, the big brokerage firm doesn't offer our products. Chances are good their broker doesn't understand what we do. But if somebody is looking for that non-correlated diversification with global exposure, then it would make sense for them to track us down. Being directionally agnostic is another advantage that we offer. Is that most investors think long only, and they just don't realize you can profit on the way down as well if you have a disciplined approach like we do. And so that's really I don't want to sound salesy because it's more philosophy. Philosophically, this is how we really feel about the markets, and that's why, looking at investors like John Henry, whom I used to work for, why he was so successful, because he just had a different philosophy and approach to markets, and that's what we have sort of carried through, and what we think what we've built even better, an approach to what we're doing today. So that's how you can track us down, and so. Don't rely on your, average advisor, because many advisors have to sort of follow their company mantra, 60-40, and that's what investors are still stuck with. So if somebody's looking for more diversification, something different, then they would want to talk to somebody like us.
Fantastic. Well, Ted, really appreciate you coming on the show today and sharing more about, a disciplined approach and what that looks like. And to the audience, as always, thank you for tuning in. Hope you got a lot of value out of this. If you did, don't forget, hit that subscribe button. Have many more great guests just like Ted coming up for you. And Ted, thanks again for coming on the show. It's been a pleasure.
Adam, can I say one thing?
Absolutely.
Just end with discipline matters. That's how we got started all this. It really does matter. As Admiral McRaven would say, make your bed. There we go.
Fantastic.